This podcast is brought to you by Moneycontrol.
Hello and welcome to Moneycontrol's Personal Finance Podcast, brought to you by Kuvera.in, India's first completely free mutual fund investing platform. You are listening to Lisa Pallavi Barbora, and joining me for this episode is Chintan Haria from ICICI Prudential Mutual Fund. Chintan heads product development and strategy for the asset manager. Hi Chintan.
Hello to all the listeners of Moneycontrol.
Today we are talking about hybrid funds. ICICI AMF, of course, is one of the leaders in this space with a very good well-stocked product basket in this area, roughly about 70,000 crores of assets under management. That's a lot to manage in the hybrid space, isn't it?
Yeah, so the way we look at it is India is a large market, and we believe hybrid funds is one of the better ways to invest. In terms of it being large, I think there is unlimited scope in terms of people investing in hybrid funds. So even at 70,000 crores, we are just a small fraction of the savings that we have. Annually, Indians save about close to $250 billion odd. That $250 billion, if I translate it in rupee lakhs, it's in lakhs and lakhs of crores, and we have only 70,000 crores with us.
Right.
I think the scope is unlimited.
Great. So let's begin this then. There is a school of thought that hybrid funds or balanced funds are meant for conservative investors only. What about investors who are looking to create wealth in the long term? They need a little bit more risk perhaps. Is there room in your portfolio of hybrid funds for investors like that?
So fair. In India, when we say aggressive investor, probably an aggressive investor has 20% in equity or 30% in equity. So in India, very rarely do we find aggressive investors who have 100% in equity. Just as a statistic, as an overall savings of $7 trillion, we have only 5% is in equities. So while we speak a lot about equities and most of the investors get jittery looking at prices every day, only a fraction of our investments are in equities. What hybrid funds provide, and the hybrid funds are also various categories which we'll probably touch upon later. It has a solution for every investor of every kind. An aggressive investor may have a hybrid fund which he can choose, and conservative investor can have a hybrid fund which he can choose. So each and every kind of investor has a suitable hybrid fund where he can invest. So let not the investor get worried about the fact that I am aggressive, why should I invest in a hybrid fund? I think a suitable hybrid fund is available, which we can discuss as we move along.
Yeah, so that's where we are coming to. So how does one choose? But among the various types that are available, we know that all schemes have some portion of equity and debt in some proportion. But how can I tell what's right for me, what I want at that time?
Yeah, so to make it simplified, I think what has happened since 2018 is the regulator has simplified all the mutual fund schemes. There are categories for each mutual fund scheme. So for example, the equity savings category, right? If you look at that category, it has less equity component, say 10 to 50% in equity. Then there is the balance advantage or a dynamic asset allocation category, which can have 0 to 100 theoretically. And then there are multi-asset funds also, which invest in gold, equity and debt. So an investor who is, say, aggressive can choose a balance advantage or dynamic asset allocation category where he can get higher equity levels. And an investor who is conservative can choose the lesser equity funds like equity savings category.
Okay. So where the allocation is static, where I know that, there is going to be, between say 60-65% in equity, the rest in debt, I can make a one-time decision. But when it comes to dynamic asset allocation in the hybrid portfolio, it is always hard to define an objective with these funds because the hurdle keeps changing depending on how the markets are doing at any particular point in time. As an asset manager, how do you define the outcome for investors in these kind of dynamic products?
In fact, it's the exact opposite. The hurdle keeps on changing if you invest in a static investment product, right? Because you may invest in expensive markets in higher equity. If that equity is lower in that particular product when the markets are expensive. Say, for example, just as a hypothetical, if markets are 11,500 today and you invest a bulk of your investment in a high equity product and markets fall, tomorrow when the markets fall, you end up losing a lot. What dynamic asset allocation funds do essentially for you is manage that particular equity portion in a way that when the markets are cheap, you have more equity. When the markets are expensive, you have less equity. So you don't have to worry when you are investing in a dynamic asset allocation product because we as a manufacturer, as an AMC, are handling that particular portion for you. So for all those who want to invest and don't want to worry about the market level, can't understand whether I should do SIP or lump sum, it does not matter. dynamic asset allocation funds are exactly the solution that you should be having in your portfolio.
Okay, but what can one expect with a static allocation? One can expect to benchmark it, right? And okay, if the markets are not doing well, your fund probably will not. But in case of a dynamic asset allocation, that clarity, doesn't come intuitively.
Yeah, so thank you for asking that question. Essentially, the whole objective of dynamic asset allocation funds is to ensure that you fall less when the markets fall, because you have lower equity when the markets fall from expensive territory, and you participate in the rise in market. Essentially, when you buy low and sell high, and when you do what dynamic asset allocation funds do, your return experience becomes a bit more smoothened. You end up with a better investor experience, because most of us get afraid of losing money, right?
Yeah.
What these funds are meant to do is protect you on the way down, and hence from a perspective of say 5-year, 10-year, 15-year return, we have a strong belief that the risk-adjusted return or the returns in these particular products, adjusted for the fact that investors will not be worried when the markets fall because they won't lose. The biggest fear which people have is they lose money and then they go out of the markets, right? They come in when there's euphoria, they go out when the markets are probably lower. This is what is avoided by dynamic asset allocation funds, and hence your ultimate return expectation or return objective is managed because you end up being invested for longer.
Okay.
The biggest problem that we've seen investors have is, while markets may have given 10-year 150% return, for example, how many of us are actually invested for 10 years?
Yeah,
That gets probably, the greed and fear also gets adjusted or probably satisfied with the dynamic asset allocation
because the
funds.
experience is of more stable return.
Yes, the experience, the volatility does not shake the confidence of the investor. The investor does not necessarily see a big drawdown or a losses on his portfolio over a period of time. So we say that 3 to 5 years you invest in dynamic asset allocation funds, your return experience will be probably as good, and the whole objective is that you will not lose money, which is what most of us don't like, right? None of us like losing our hard-earned money.
So when you say it's more suitable for an aggressive investor, that's because of the quantum of equity in it?
So I'd say the quantum of equity in dynamic asset allocation fund changes with valuations.
The only reason I'm asking is because we are talking about stable return and aggressive investors.
Yeah, so an investor is conservative when the markets are weak, and an investor becomes aggressive when the markets are expensive and doing well. So an investor also changes his category based on where the market is.
Absolutely.
To avoid this greed, fear, and investor knowing ultimately what does an investor want? An experience, a return experience, a risk-adjusted return experience, which is good.
Right.
And that is what we try to do with asset allocation funds, wherein they are taking care of the investor's return expectation, at the same time taking care of investors' fear expectations.
Okay. So perhaps the biggest criticism that the balanced fund or the hybrid fund category gets is the lack of personalization, because everybody's requirement, while there is a need to have an asset allocation across equity and debt, every individual's requirement could differ. And that's why, even advisors kind of shy away from this category, because, they tend to define or customize the asset allocation a little bit more. And what suits one doesn't suit the other. So how do I use even a simple static allocation hybrid product efficiently in my overall portfolio of various funds or different kinds of investments?
So in fact, if we see the last 3 to 4 years, things have changed. What you mentioned obviously was true probably 10 years back, but in the last 3 to 4 years, we've seen significant inflows into the static hybrid category, or the balance category as it is generally called, because people have realized that if they have a balance of 70% equity, 30% debt, in the long run, it's a good combination because India in general is a long only market, wherein in the long run with GDP growth, market cap will also grow, companies will also perform, and hence that 70% allocation in equity gives that kicker, and the 30% allocation in debt gives the shock absorbing capacity, or let's say it accrues debt in terms of the returns. So the experience of investors in hybrid category has been reasonably good in the last 3 to 5 years, and hence even advisors are now actually selling hybrid funds a lot more than they used to sell 10 years back. Because essentially you're getting debt investment of 30% at equity taxation, and we know that equity taxation is today beneficial relative to debt investments.
Yeah, that's true. At least if you are able to hold for the long term.
That's a given. If you're investing in equities, it's like participating in a business and you basically have to have 5, 10, 15 years horizon.
Even for balance?
Even for balance. The longer you keep, the better it is. Of course, if there are exigencies and you need to take out money for exigencies, it's fine. Otherwise, any equity investment in general has to have the longest time horizon. You may move from one equity product to the other depending on what suits you. But if you are invested in equity, you remain invested for 5, 10, 15, 20 years. Only then will you see the power of compounding, basically ensuring your wealth creation is there in equities. Otherwise, you'll end up with mediocre returns in equity.
Okay. Great. Thank you, Chintan. So hybrid funds perform the job of providing this balance between risk and return.
That's why they're called balanced.
Yeah. And as you were saying that they are available for all types of investors, whether you're conservative or aggressive, and for all needs of investment per se. So thank you so much for joining us today for this discussion, Chintan. Thank you, listeners, for staying tuned in to this episode. Remember, mutual fund investments are subject to market risks. Read all scheme documents carefully before investing. Do your homework, and if you have any queries, you can write into mcpodcast@nw18.com. That's mcpodcast@nw18.com. For more news, views, and updates, stay logged on to moneycontrol.com. Thank you.